this is Anna Pinedo, and I'm a partner in the New York office. Today, I'm joined by Laura Richmond, Candace Jackson, and Robert Cray. We're very pleased that you decided to tune in and join our session today. A couple of administrative comments. So all of you have been muted upon entry to today's session and remain muted during the course of the program. We're delighted to take questions, and we'll try and respond to the questions as we go through the materials. And if we don't get to a question, we'll try and come back to you directly with questions. So just use the chat function and type your questions in, and one of us will be watching for questions. We'll also try and leave a little bit of time at the end if we can to answer any questions that we haven't gotten to. A number of you probably are listening today and would like CLE credit. So you should have received 2 forms, an affirmation form and an evaluation form. Please just follow the instructions on those and return them to Mayor Brown to the address that's provided on the forms together with the CLE code. We're going to read the CLE code once in the middle of today's presentation and once toward the end of the presentation for those of you who may have missed it. So just listen closely for that. And with that, I think we'll get started since we have lots of ground to cover and we want to try and get through as much of it as we can today. So Melissa, I'm just going to ask you to flip to the next slide, and we're gonna end the next one on COVID. So we're going to start the presentation first by tackling COVID related issues and talk about COVID-19 considerations as you begin to think about drafting the proxy statement and also this year's annual report on Form 10K. There's a lot of guidance to look toward from the SEC staff. So just as a recap in terms of the sources of the guidance that was issued early on by the SEC staff in Corp Fin Disclosure Guidance Topic 9, and we'll go to the next slide. That covered 3 basic topics on assessing the impact of COVID. It reminded public companies to be attentive to how they're handling MNPI, and the SEC staff has been emphatic in recent months that companies need to take special precautions regarding MNPI during this time of rapid change. We'll go on to the next slide, Melissa. Also in that disclosure, in that statement and in the joint statement that was made by Corp Fin Division Director Hinman and SEC Chair Clayton, they focused on the importance to companies that are producing disclosure to think about having their disclosures be forward-looking. Obviously, historical information is of relatively less significance and less help to investors as they're trying to consider results of operations and understand the trends that are affecting the company. And if we go on to the next slide, the more important aspects oftentimes will be those that are disclosed in the trends section of MD&A and that are discussed in the body of the business section that relate to how, as the pandemic has evolved, it has impacted the company and how the company believes that it will be impacted in future periods. If we go to the next slide, later in the summer in June, there was another Corp Fin disclosure guidance issued, and this is topic 9A, which addresses a number of disclosure obligations, and we'll go to the next page, specifically focused on financing activities, going concern issues, tapping credit facilities, or accessing the public or private markets to raise additional capital to bolster a company's resources. And then last, but by no means least, the guidance that has come, and we'll go through this on the next slide, from the SEC's Office of Chief Accountant. In various public statements, the Chief Accountant has addressed the significance of high quality financial information. So while the Chief Accountant has focused on the fact that during this period, audit committees and those involved in the reporting function within companies are going to be called on to make significant judgments and estimates, the SEC staff is not going to question or object to well-reasoned judgments, provided that companies are thoughtful about disclosure and provide disclosure that's understandable and that's useful to investors. The Chief Accountant's Office has also reiterated the importance of ensuring that companies are diligent about their disclosure controls and procedures during this time, as well as internal control over financial reporting. And obviously, it's management's requirement to evaluate the effectiveness of the company's disclosure controls and procedures as of the end of every fiscal quarter. That's going to be a big task at year end, and the effectiveness of internal control over financial reporting at the fiscal year end. So with that in mind, we're going to first go through some of the proxy statement disclosure considerations, and we'll go to the next slide. And then we'll turn to annual report time. So of course, today's presentation is summary in nature. When we get to the end, you'll see we've included some links to some of our more detailed alerts and articles on these topics. But today we're just going to try and flag some of the things that should be top of mind as you start with preparations for proxy season and annual report season. So within the proxy statement, compensation disclosures are an area to focus on. For a number of companies, they've undertaken various cash pay reductions, reductions in force, furloughs. Many of the named executive officers may have agreed to forego portions of their salary or agreed to temporary or permanent salary reductions, or agreed to forego or reduce their bonus or forego perks. So it's going to be important to think about all of these things as the compensation committee is considering disclosures for the proxy statement. For many companies, it may have been a little early to think about repricing options or making other sort of broad-based changes or adjustments to compensation, but that's certainly something to think about as we head into year end. Likewise, for companies that have to draft a CD&A section, that's probably going to require a little bit more time and effort this season, specifically when discussing and commenting on historical performance and thinking about the design of the bonuses going forward, or the design of other incentive programs, the timing of awards, which may have changed, the metrics, which may have changed. So all of those issues are important to think about as the drafting for CD&A and for the compensation section of the proxy statement is underway. With that, we'll go on to the next section, next slide, corporate governance disclosures. So the SEC, as well as the PCAOB, have commented throughout this process and have reiterated the importance of the board's role and the audit committee's role in oversight and in the oversight of risk. So the proxy would be a good opportunity to highlight what's changed. Have there been additional meetings during this time? Has the board been involved in company discussions regarding reductions in force, closures, or other similar cash saving measures? what consideration has the board given to workplace safety and human capital measures? As we go through today's presentation, you'll see that human capital and workplace safety issues have taken a prime role in terms of the types of issues that institutional investors and that investors care about. During this time, there has been a notable increase in incidences of cyber breaches, phishing, and other similar challenges. And oftentimes it's the audit committee, maybe a separate risk committee, that is charged with oversight of a company's cybersecurity program. So this would be a time to think about the effectiveness of those efforts, as well as the role that the audit committee or the risk committee has played during this time. We'll go on to the next slide. Audit committee reports also require special time during this period. So the audit committee report is a place to think about all of the comments that I alluded to that have been made by the chief accountant, as well as the report that the PCAOB released relatively recently regarding its conversations during the pandemic period with audit committee chairs. So things that one might consider discussing in the audit committee report would be any challenges or any changes that have come about regarding how the audit committee interacts with and communicates with the CFO and the accounting staff, how the audit committee communicates or the regularity or form of communications with the company's auditors, any challenges certainly relating to the company's internal control environment. Likewise, the audit committee's role in vetting non-GAAP COVID-19 adjustments or KPIs. Finally, the letter to shareholders. So of course, this is not a requirement, but this is a perfect place in light of the turbulence of the year and the challenges that many industries have faced for management to provide its view of the company and its employees, and to provide a little bit of insight for shareholders. And there are any number of topics where the letter to shareholders might provide a perfect sort of venue for discussing how the company sees its performance evolving and the challenges that it faces in the coming months. So with that, I'm going to turn quickly to 10K disclosures. Here as well, we can all look at CorpFin guidance, and we can also look to some of the SEC comments that are starting, comment letters that are starting to become public that contain COVID-19 disclosure observations from the SEC staff's review of now at least 2 rounds of 10Qs during the pandemic period. And so there'll be a need to address COVID issues in all of the principal sections of the 10K. We highlighted a few there. Maybe we can go to slide 16 on risk factors. So this is the time when a company should really bear down and try and review very carefully all of its risk factors. In the early days of the pandemic, the approach that many companies took was to include one sort of generic or one risk factor that described all things pandemic related. Well, the situation's now evolved. We're many months into it, and it would be an appropriate time to try and tailor the company's risk factors, really do a wholesale review of risk factors and address all of the things, all of the different aspects that are affected by the pandemic. We included there a sample SEC comment, which is really asking for more tailored, more detailed disclosures. We anticipate that that's going to be a frequently repeated comment as we dive through and look at all of the SEC comment letters that have become public in recent weeks. And business, we go to the next slide. while Bob will talk about the additional flexibility that registrants have with respect to their presentation of the business in the business section of the 10K this year, this may actually be a time when a company chooses to present more of a fulsome discussion of its business as it's evolved or as it has been impacted by the pandemic, instead of relying on the changes to Regulation SK and doing an abbreviated or a summary discussion. Finally, MD&A. So this is probably the section that we'll all end up spending the most time on. The staff's guidance has touched on lots of issues to be addressed in MD&A. So the effects on actual results, effect on liquidity, including changes to the company's credit agreements or to other debt obligations, forbearance agreements, and the like, financing transactions, going concern issues. If we go to the next page, there are a number of issues that the SEC staff has highlighted. So for example, for many companies, they have a regular practice of testing for impairment and testing goodwill. This would be a time, for example, to talk about the effects of impairment tests on long-lived assets, on intangibles, on goodwill. Time to discuss contract modifications and the impact that may have on revenue recognition. A time to talk about and evaluate subsequent events. I talked a little bit about going concern issues. That is going to affect a number of companies. And if we go to the next couple of slides, we have highlighted some recent SEC comments relating to future trends. So the MD&A has always been, from the SEC staff's perspective, a way to allow an investor to see the company and understand the company's results of operations through the eyes of management. And one of the key aspects or key requirements of item 303 of Regulation SK is to provide some insight on known trends. While it may be difficult during this pandemic period to think about what is known or knowable versus all the many unknowns, it's incumbent upon the financial reporting staff at companies to try and provide some insight and do more than just report on period to period changes, and actually provide, we'll go to the next slide, actually provide some sense of the company's expectations regarding how COVID-19 will apply to or affect future operating results. The last topic on the next slide, COVID-related non-GAAP adjustments. So I think a number of companies took liberties or were a little bit perhaps more creative with their COVID-related adjustments. We have already seen an increase in the number of SEC comments on non-GAAP adjustments, in particular those related to the pandemic. This would be a good time to scrub and think about, and we'll go to the next slide, whether adjustments were one-time adjustments, and whether, as we continue with the pandemic period, some of the adjustments that were perhaps thought of as one-time occurrences now maybe should be thought of as recurring. So that's a very quick trip through proxy statement and 10K considerations. There's more in the materials that we're providing. And with that, I'm going to hand it off to talk about virtual annual meetings to Laura.
Thanks, Anna. This is Candace. So we'll take a look at some statistics from the 2020 virtual annual meeting season. Prior to the pandemic, it was very common for companies to expect low shareholder attendance and participation at in-person annual meetings. The virtual meeting format certainly changed that. According to Broadridge, average attendance at virtual annual meetings was 50 people in 2020, with small cap companies seeing an average of 30 attendees and large cap companies seeing an average of 122 attendees. An average of 5 questions were asked, with one company even fielding 316 questions. 97% of companies took live questions, while 11% asked that shareholders submit their questions in advance. You can move to the next slide. As you might expect, meetings with shareholder proposals on the agenda had greater participation. They were longer at 34 minutes compared to 18 minutes for those without shareholder proposals on the agenda. They had more attendees on average, and those attendees asked more questions, were more likely to vote during the meeting, and were more engaged prior to the meeting. Moving on to the next slide. So what should you be thinking about in preparation for the 2021 virtual annual meeting season? First, you want to make sure that virtual only meetings continue to be permissible in your company's state of incorporation. While Delaware allows virtual only meetings without restrictions, other states like New York put emergency orders in place last spring in order to permit virtual only meetings. Some of those orders are still in place and some are not. So you'll want to make sure that the virtual only format is permitted in your company's state of incorporation at the time of your planned annual meeting. This year, as companies plan in advance for the annual meeting format, the virtual format, we don't expect to see the defective notice issues that we saw this past spring, but be sure that you're providing notice of your virtual format as required by bylaws. It's important to begin planning for the virtual meeting and thinking about timing considerations. It won't hurt to get your meeting date on your virtual meeting service provider's calendar sooner rather than later. Although most of them don't expect to see the calendar issues that they had last spring. You'll also want to be thinking through your plan for making the shareholder list available for inspection and making sure to disclose where and when it will be available. Moving on to the next slide. As you start thinking about the proxy statement, this is the time of year to start updating D&O questionnaires. And here are a few important reminders. There aren't substantive regulatory and rule updates this year, but you may be making updates in order to collect more diversity demographic information this year. So you'll want to make time for updating D&O questionnaires for that. Next slide. You'll also want to start thinking about pay ratio disclosure this quarter. Looking back at 2020, the average pay ratio among all companies was 76:1. The S&P 500 median increased quite a bit from 160 to 178:1, while other peer indices saw either small declines or small increases. Next slide. We're going into the 4th year of pay ratio disclosure. So for companies that have been reusing their median employee since year 1, you'll be required to recalculate the median employee this year. So it's important to get that process started early. It can be quite time consuming. For companies that may have recalculated the median employee in year 2 or 3 and are thinking about reusing the median employee, there are a few things to keep in mind. First is that COVID-19 caused many companies to make workforce reductions and to implement furloughs in 2020. So every company that is considering reusing its median employee should also be considering whether there was a substantial change in the employee population or a substantial change in their compensation program in 2020 that would preclude them from reusing the median employee. Second is that if you can reuse the median employee, but your median employee is no longer employed by the company, remember that you can substitute another employee who has substantially similar total compensation using the same consistently applied compensation measure that was used to identify the original median employee. Next slide. Next is a quick look at Say on Pay support in 2020. While average support was pretty much flat in 2020 compared to 2019, the percentage of companies receiving 90% or better approval was down for both the S&P 500 and the S&P 1500. Next slide. Say on pay proposals failed at 10 companies, and ISS negative vote recommendations increased about 1% at S&P 500 companies. Some contributing factors were special equity awards granted in consecutive years, excessive annual incentive awards, the acceleration of PSU grants, and CEO pay for performance misalignment. Next slide. While we're talking about proxy advisor recommendations, ISS, many companies, as Anna said earlier, reduced base salaries and cash compensation for at least some portion of 2020, but very few have actually made changes to their incentive compensation programs. ISS did release guidance in October that suggested that base salary reduction would be a mitigating factor when they're looking at compensation program changes, but they would really prefer to see target incentive compensation also reduced to reflect the reduced base salaries. Next slide. ISS also included in that guidance a non-exhaustive list of points that should be covered by proxy disclosure when disclosing changes to annual incentive compensation programs. So it's important to become familiar with the FAQs that were released by ISS in October. When considering changes to incentive compensation programs, keep in mind that both ISS and Glass Lewis will view any changes to the outstanding long-term incentive compensation awards negatively. ISS recently announced that it eliminated the draft report review process, so you won't have that time to review ISS's draft report and make corrections prior to the final report being issued. They expect that this is going to allow more time for investors to review final reports and recommendations. So that is another thing to keep in mind. Next slide. Compensation committees should also be aware that Glass Lewis will look unfavorably on payouts above target for annual bonuses, where the annual performance goals were adjusted downward this year. Overall, companies with strong governance and a history of strong pay practices will get a little more leeway in how they respond to the pandemic. I'm moving to the next slide. The SEC recently published new perk guidance to help companies in determining whether or not certain expenses related to the pandemic are going to be considered perks. The SEC will continue to apply its long-standing test to these pandemic expenses. So first, it's important to determine whether the expense is integrally or directly related to the performance of the executive's duties. For example, reimbursement for enhanced technology to make it possible for an executive to work from home. The SEC would not consider that a perk because it is integrally related and directly related to the performance of their job. This may not be the same outcome from a tax perspective, so it's important to keep that in mind. And you'll have to analyze the expense from both perspectives. If the expense isn't integrally or directly related to job performance, it may be a perk unless it's generally available to all employees. And with that, I'll turn it over to Laura.
Thanks, Candace. So talking about human capital, first let's be aware that it had already become a hot topic before COVID hit. But when the pandemic came to the U.S., human capital concerns such as adapting to a remote work environment or protecting employee health and safety, succession planning, all of those issues became magnified. And then on top of the pandemic, there were protests highlighting issues of social and racial injustice, and that brought scrutiny not only to workforce diversity, but also to talent development issues geared to encouraging diversity at all levels of an organization. Now, just to be clear, and we've talked about some of this already, proxy statements already discuss on a required basis matters that fall within the rubric of human capital. You have board diversity, Candace mentioned pay ratio, and Anna talked about board oversight of risk, and sometimes companies have a shareholder proposal, human capital related, such as gender gap in pay. So we already have some of this in proxy statements and are required to, but there's something beyond that. Next slide, please. Slide 37, we already have large institutional investors who consider human capital management a priority for engagement. BlackRock, as you can see on this slide, has had a lot of engagements, and actually it was almost 3 times as many human capital engagements as they had in the prior year. And we've had the New York City comptroller calling on companies that made statements committing to diversity and inclusion being pushed to publicly disclose their equal opportunity report data. And ISS, not an institutional investor, but as everybody knows, quite powerful these days, has requested companies to disclose self-identified race and ethnicity characteristics of their board. Next slide, please. So in this environment, I think we're going to see a lot more human capital discussion this proxy season. And this could be in a combination of ways. There could be website disclosure, proxy disclosure, as Babel mentioned, 10K disclosure. But we already have seen a trend towards voluntary human capital disclosure. So you can find precedents from the 2020 proxy season showing this. They might have a separate section on human capital management, touching base on particular issues they want to call out. They may want to focus on the board's role in human capital management, and they may talk about shareholder engagements on this topic. And this may show up, as Anna alluded to, in board or CEO letters. Next slide, please. So moving on to ESG, I want to make the point that human capital has not eclipsed other ESG issues. What we have is environment remaining a huge issue. And we have institutional investors who are making it clear that these issues are important to them, and environmental shareholder proposals that are gaining traction. And there are multiple third-party frameworks that have been growing in influence, and they're being embraced by large institutional investors such as BlackRock and Vanguard. And there's a number of organizations that are separately rating ESG. Next slide. So we also, from a regulatory point of view, we have the SEC's Investment Advisory Committee, which has recommended ESG disclosure requirements. That's on an advisory basis only, so the SEC doesn't have an obligation. But I'll point out that the SEC's 2 current Democratic commissioners have been very vocal about wanting the SEC to adopt specific ESG disclosure mandates. So, it's quite possible that an SEC with a majority Democratic commissioner on it would consider ESG disclosure rules, but that's not going to happen in time for the 2020 proxy season. Also, though, I'll point out that there's a growing interest in ESG investments, whether that be specific bonds or funds or just using stock ownership as a platform. But that is also driving ESG disclosures because it is important to investors. And as we've mentioned before, ESG has become a governance matter that is becoming influential in how companies operate and how they present themselves. Next slide, please. I do, yes. I want to emphasize, and I think this is the prior slide, but I do want to emphasize that if you're doing voluntary disclosures, whether it's human capital or ESG, it is important to be mindful of the securities law implications of voluntary disclosures. Next slide, please. You want to be talking in terms of goals and aspirations as opposed to commitments, unless you're really, making a commitment that the company wants to stand behind. It's also critically important that if you say something, it's got to be accurate, which means you may want to be wrapping ESG or human capital issues into disclosure controls, and it might also be impacting internal control issues. So you need to include this in the process. I'd urge that you begin this drafting early, particularly if it's new, because a lot of people within the company and your outside advisors will need to look at that, and you need to coordinate the message with other disclosures the company's making, annual report, proxy statement, website, shareholder engagement, presentations, press releases, etc. Next slide, please. Board diversity, that's part of the ESG, and I just want to point out that California not only now has, which it's had for a while, a requirement that companies headquartered have at least one woman on their board. They've got a new law now that is requiring boards of companies, public companies headquartered in California, to have members of underrepresented communities identified on the slide. And California put some teeth in this by having the ability to impose monetary penalties. Next slide, please. This is an area where institutional investors have weighed in, some seeking more disclosure, others looking to be sure that you have women and people of color in the pool for all appointments, seeking greater diversity and raising the scepter of voting against non-gov committee members or other directors if there's not adequate board diversity. Next slide, please. An ISS may vote against companies if there's no women on the board. And this year, beginning February 1st, 2021, a firm commitment to appoint at least one woman isn't going to cut it anymore as a mitigating factor. They're expecting people to be working on it now. Next slide. So in the area of shareholder proposals, just a reminder, the SEC changed its procedures and doesn't automatically answer a no action request in this area with a letter. Instead, there's a chart which will indicate if there's a letter, but at least it will indicate whether the SEC concurred or didn't concur or stated a view. And it is really a helpful resource because in one place you can see what all the letters were, and it makes it easier to figure out which companies may have had similar experiences. And this is something the staff is proud of, and going forward, they're looking to make it more interactive and sortable. Next slide. So in terms of shareholder reports, shareholder proposals that received majority support in the governance area during the 2020 proxy season, you had elimination of supermajority voting requirements, elimination of classified boards, and majority voting for election of directors. All had some majority approvals. And then in addition, you had numerous proposals involving shareholder written consent, rights to call special meeting, independent board chairs, and they frequently received support over 30%. And when there's significant minority support, that also has an impact. On the social front, there was strong support for board and workplace diversity proposals, and also on reports involving political spending and lobbying. And for environmental risks and strategies, we saw a number of those pass, and others that received substantial majority support, often in the 20 to 30% range, and sometimes just missing majority by a little bit. Next slide. So thinking about 2021, the reports that the proposals that got majority support, we're likely to see similar themes this year, and maybe proposals going off on a new direction, such as environmental proposals seeking disclosure of externalized costs, social and environmental costs to be disclosed, not just things that directly hit financial results of the company. Keep in mind that the COVID pandemic hit after the deadline for most shareholder proposals during 2020. So expect this year that there may be more shareholder proposals on issues like health and safety and other pandemic related issues. And also expect that there may be some additional racial and social injustice inspired proposals geared towards workforce diversity and equal opportunity. Next slide. I will mention just briefly that the, back one slide, the SEC adopted amendments to the Shareholder Proposal Rule 14A8, but they don't become effective until next proxy season. So just be aware that the submission thresholds were updated, as were the resubmission thresholds, with the one person, one proposal rule clarified. But now let's move on to proxy voting advice, where the SEC codified its position that proxy voting advice is solicitation, and it also imposed new conditions to exemptions from the proxy information and filing requirements that proxy advisors rely on, and these were relating to disclosure of conflicts and procedures to allow all companies access to their reports prior to the release of the advice, and a mechanism for clients to get those responses before they vote. Next slide. The solicitation codification as proxy voting advice as solicitation, now that's effective. So the proxy advisors do have to be concerned about material omissions from their reports. But the transition period for the new condition for exemptions means that the real force of those amendments won't come into place until the 2022 proxy season, and it's possible the regulation could be looked at before then. And I will also point out that ISS resumed its litigation in this area. Both ISS and the SEC have filed motion for summary judgment in this litigation. So hearings on these cross motions are expected December, maybe January. So there may be a decision shortly after that. You know, I think that's the goal of the litigation. But that's something we need to stay tuned on. But now we'll move forward, and I'll turn the program over to Bob.
Thank you, Laura. Today, I'm going to discuss 4 key areas for consideration when preparing this coming year's 10K or 20F. Risk factors, critical accounting matters, or CAMs, recent amendments to the business, risk factors, and litigation items of Regulation SK, and recent SEC guidance with respect to MD&A and the proposed SEC amendments to MD&A. Slide, please. Annually updating risk factors is a key component of preparing Forms 10K and 20F. As I hope you know, this is not a one-size-fits-all exercise. Risk factors should be tailored for specific issues affecting the company at the time of filing. While the prior year's risk factor presentation could be a good starting point, following an analysis, companies should consider whether it is appropriate to discuss new risks, to supplement or revise previously disclosed risk, or to delete some. In that regard, in addition to the COVID-19 topic that Anna discussed in the first segment, there are other trending risk topics this year that companies should evaluate from a risk factor perspective, including cybersecurity, LIBOR, Brexit, intellectual property and technology risk, and of course, other risk factors specific to a company. Let's start with cybersecurity. Cybersecurity incidents and ransom demands have continued to plague business, and therefore, cybersecurity remains a significant risk factor that most companies need to address in their Form 10Ks. COVID-19 may need to be discussed as part of the cybersecurity risk factor to the extent that operating through a remote workforce contributes to cybersecurity risk. But even outside the COVID-19 context, companies should carefully assess their current cybersecurity risk factor disclosures and related privacy concerns to determine whether additions or modifications are needed to reflect up-to-date conditions. Indeed, in December of last year, the staff issued disclosure guidance topic number 813, which discussed disclosure obligations that companies should consider relating to intellectual property and technology risks associated with international business operations, particularly in jurisdictions that do not have levels of protection comparable to the U.S. protections for corporate proprietary information and assets. This guidance suggested various questions that companies should consider to assess their risks and disclosure obligations relating to potential theft or compromise of technology and intellectual property, and how those risks may impact their businesses. As I'll discuss in a few moments, this past August, the SEC adopted amendments to Regulation SK that are intended to modernize the business, risk factor, and legal proceedings disclosures. Although these amendments to the business and legal proceedings disclosures do not impact or benefit foreign private issuers that do not use forms that reference the relevant SK disclosure requirements, for example, companies that file annual reports on Form 20F, the amendments to Item 105 regarding risk factors will apply to foreign private issuers filing registration statements on Forms F1, F3, or F4. New slide, please. These Item 105 risk factor amendments require a risk factor summary of not more than 2 pages in the forepart of the annual report or prospectus. If the risk factor discussion exceeds 15 pages, to focus disclosure on the risks to which reasonable investors attach importance in making investment and voting decisions, the SEC changed the risk factor disclosure standard contained in Item 105 from the not clearly defined, quote, most significant risks to the well-defined standard of all material risks. The amendments also require companies to organize their risk factor disclosure under relevant headings. If a company chooses to disclose a risk factor that could apply to other companies or securities offerings without explaining why the identified risk is specifically relevant to investors in the company's securities, the amended rule requires such generic disclosure to be placed at the end of the risk factors section under the caption General Risk Factors. Slide, please. As I mentioned earlier, in addition to the amendments to the risk factors SK item, the SEC adopted amendments to Regulation SK that are intended to modernize both the business and the legal proceedings disclosures by moving away from a prescriptive line item disclosure requirements to a principle-based disclosure requirements that rely on a company's management to evaluate the significance of information. In doing so, companies need to determine whether disclosure is necessary and forget the previous look-back period orientation to focus on material developments without regard to a specific time frame. Therefore, companies will no longer need to address all topics listed in Item 101A if they determine that one or more of those topics are not material to understanding the general development of the company's business. With respect to the business description Item 101C, in addition to the amendment to the general approach to the business disclosure requirements of SK, requirements for this item have several notable specific amendments. The first is a new human capital disclosure. And although declining to define human capital, the amendments will require disclosure of, 1, the company's human capital resources, including the number of employees as currently required, and 2, any human capital measures or objectives that the company focuses on in managing the business, such as measures or objectives that address the development, attraction, and retention of personnel. The second notable amendment to the SK business item is with respect to governmental regulations. The amendments will require disclosure of the material impact of compliance with all governmental regulations, not just the current requirement that applies to only environmental regulations. And finally, the current list of prescriptive disclosure items in SK business item will be replaced for companies other than smaller reporting companies by disclosure topic examples and the flexible requirement that companies disclose only information material to an understanding of the business taken as a whole. For example, a company would need to describe its dependence on key products and services that are material to the investment and voting and decisions of investors, instead of describing products and services that meet quantitative thresholds as previously prescribed. Slide, please. With the goal of modernizing the SK legal proceedings, item 103, the amendments allow the disclosure of legal proceedings to be provided by hyperlink or cross-reference to disclosure elsewhere in the document, such as in MD&A, risk factors, and notes to the financial statements. Slide, please. In fact, this past Thursday, November 5th, the staff published 3 item 101 and 103 transitional FAQs regarding amended items, SK items 101 and 103. First, the staff made it clear that for prospective supplements filed after November 9th, which is today on, with respect to registration statements that were effective prior to November 9th, yesterday, issuers don't need to comply with new items 101 and 103 or amend their 10K currently incorporated by reference in the registration statement to comply with items 101 and 103. The staff's second FAQ response acknowledged that the amendments don't require 10K disclosure of new item 101 business developments for more than the fiscal year covered by the current 10K. New slide, please. Finally, the staff stated that a registrant may omit the full discussion of the general development of its business item in 10K if the registrant makes the disclosures listed here in this slide. As you may recall from last year, any matter, or new slide, please. There we go. As you may recall from last year, any matter arising from the audit of a company's financial statements that was communicated or required to be communicated to the audit committee will be a critical audit matter, or a CAM, if it both relates to accounts or disclosures that is material to the financial statements, and 2, involves an especially challenging, subjective, or complex auditor judgment. CAM disclosure is likely to impact many companies and may involve more than one CAM. However, not every matter that the auditor discusses with the audit committee will necessarily be a CAM. This past year, audit reports for large accelerated filers were the first required to disclose CAMs, or a statement that the auditor determined that there were no CAMs. Now, the CAM provisions will become effective and apply to all other companies for fiscal years ending on and after this December 15th. This means some companies will have CAM disclosure in their Form 10Ks for the first time during the 2021 annual report and proxy season. New slide, please. Determination of whether an accounting issue is a CAM involves a principle-based analysis. Here are some examples of topics that will likely constitute CAMs depending on the facts and circumstances. Clearly, many areas of disclosure, the COVID pandemic may have an impact on CAM disclosures this year. According to a report published by the Center for Audit Quality, the pandemic could increase the subjectivity and complexity of a specific audit area such that it meets the definition of a CAM when it otherwise may not have been prior to the pandemic. It also could result in the expansion of CAMs that were reported last year to include new assumptions that were especially challenging or complex due to the pandemic and or result in changes to the auditor's response to a previously identified CAM. New slide, please. To ensure a smooth implementation process and few potential surprises, companies, particularly CAM first-timers, should be working closely with their auditors to determine the methodology the auditor plans to use to identify potential CAMs and to identify as early as possible which matters may be considered CAMs. Completing dry runs with the auditor's help in this regard and is highly recommended. Such dry runs often entail the auditors evaluating matters that might qualify as CAMs, considering how CAMs should be drafted, and discussing potential CAMs with both management and the audit committee to help them understand and prepare for this disclosure, and importantly, its impact. Finally, companies with anticipated CAM disclosure should also consider where, outside the notes of the financial statements, additional disclosures should be included in their SEC filings, such as MD&A section, which is most likely to be revisited as a result of the CAM disclosure in the notes of financials. Next slide, please. Discussing a company's financial condition through the eyes of its management in MD&A is an important part of company's disclosure. As discussed above, MD&A disclosure this year should include how COVID has impacted the company and how the company has responded to challenges of its impact. But COVID-19 is not the only factor that companies should be taking into account when preparing MD&A for upcoming Form 10-K filings. This year, companies should review the MD&A guidance issued this past January regarding key performance indicators and metrics, or KPIs, used in the MD&A as they prepare for their upcoming 10-K filings. In this recent MD&A guidance, the staff observed that some companies disclose non-financial KPIs when describing the performance or the status of their business. The SEC has indicated that any such KPI must be accompanied by disclosure with a clear definition of the KPI and how it's calculated, a statement indicating the reasons why the KPI provides useful information to investors, a statement indicating how management uses the KPI in managing or monitoring the performance of the business. You may note that the SEC's approach to the disclosure of KPIs is not unlike its views with respect to the disclosure treatment of non-GAAP financial measures. New slide, please. The MD&A guidance contains this non-exclusive list of KPIs and metrics to which this guidance applies. In addition, according to the MD&A guidance, companies should also consider whether there are any underlying estimates or assumptions for each KPI and its calculation that need to be disclosed in order for the KPI not to be misleading. Next slide, please. And if a company changes the calculation method or presentation of a KPI from one period to another or otherwise, it should make the disclosures listed here. Next slide, please. What does all this mean in practice for this coming year? Companies that disclose KPIs and metrics in their MD&A section that are derived from their own information should review their disclosure controls and procedures. Be sure these are effective with respect to the calculation of these KPIs. Review the disclosure with respect to the KPIs and metrics with the audit committee to ensure that the committee understands the performance indicators that are used. This review and any update of disclosure controls and procedures should be completed before the company makes its next filing containing MD&A, including quarterly reports and certain registration statements. And finally, to the extent that a company uses KPIs and metrics in investor presentations, including in its earnings releases, the same level of review and care should be undertaken in relation to the preparation of these presentations and the use of KPIs and metrics in these materials. New slide, please. As a result of the amendments to the MD&A that became effective in May last year, companies are permitted to omit discussion of the earliest of 3 years in a filing that includes financial statements covering 3 years to the extent that the discussion of that earlier year was already included in an SEC filing, and such later presentation identifies the location in the prior filing where the omitted disclosure may be found. In January of this year, the staff issued 3 new C&DIs to provide guidance in connection with that change. The first of these clarifies that a statement merely identifying the location in a prior filing where the omitted discussion can be found does not incorporate such disclosure into the filing unless the registration expressly states that the information is incorporated by reference. New slide, please. The second of these C&DIs explains that a company may not omit the discussion of the earliest of the 3 years if it believes it is necessary to an understanding of its financial condition, changes in financial condition, and results of operations. And the third C&DI addresses the situation where a company files a Form 10-K in which A, the discussion of the earliest of the 3 years of financial statements is omitted from the MD&A, and the Form 10-K thereupon becomes incorporated into a registration statement that is already effective. New slide, please. Further to this C&DI, the filing of a Form 10K for a newly completed fiscal year establishes a new effective date for the registration statement. And as of the new effective date, the registration statement incorporates by reference only the latest Form 10K, which does not contain the company's discussion of results for the earliest of the 3 years, unless, as indicated in the first C&DI, the information is expressly incorporated by reference. Bottom line, in all events, before omitting all or any part of the discussion of the earliest of the 3 years, companies must conclude that they would not be excluding any information that they believe is necessary to an understanding of their financial position. Thank you.
With that, Bob, thank you very much. And thanks to all of our listeners for tuning in today. We really appreciate your time. You'll see a link to our blog where we post information on SEC updates and staff guidance, as well on the next page as some resources for you to consider that have a lot more detail on the topics that we discussed today. Feel free to send questions by email to Candace, Laura, Bob, or to me. We're happy to answer them. And again, appreciate your time this afternoon. That concludes our session. And if you're seeking CLE credit, again, a reminder to send the forms back to us. Thanks so much.